All right, so following on from the Heckscher-Ohlin theory, which we learned about in the last chapter, we are now going to talk about the implications for the distribution of income and well-being between the two factors in the countries when trade opens up. And this will give us some insight into why trade can be so controversial in many countries, and possibly would help us understand why say the British decided, or at least a small majority of them decided, to exit the euro area because some people felt that they weren't participating in the benefits. So here we have two countries, the USA and Canada, and I've got some underlying assumptions to these PPFs, production possibility frontiers, that the US is a capital abundant country, which will mean that by default Canada is a labor abundant country, and that machines are produced in a capital intensive way, which means that apples, since these are ratios, must be produced in a labor intensive way. So these red lines are those curves you remember from before. These are production possibility frontiers, PPF. They tell us the combinations of two goods that are feasible with existing resources and technologies. And I'm assuming that in autarky, which means the absence of trade, both countries pick some average mix of production and consumption. From that point, if we draw a tangent at that point, we can figure out what the opportunity cost, OC, of the goods are in autarky. The absolute slope of this line I have stated is 1, which means that in autarky in the USA, one machine comes with an opportunity cost of 1 crate of apples. If we go over to Canada, you can see that line's somewhat steeper. I've given it an absolute slope of 4, which we can interpret as meaning that in autarky, the opportunity cost of one machine is 4 crates of apples in Canada. And as we've said before, when opportunity cost differs, there is a basis for trade, meaning there's a reason to trade, and that the country with the lower opportunity cost becomes the exporter of a particular good. So when trade is established between the US and Canada, we will see the US specializing in and exporting machines, and the Canadians specializing in and exporting apples. So what does that mean for income? Well, let's just illustrate what's going to be happening. If the US starts trading with the Canadians, they start moving down in this direction, down their production possibility frontier. And so if we think about what that really means, that means that they will be cutting back on apple production, planning to import apples from Canada instead. Let's say they get this far before increasing cost stops them. So we expect to see a fall in output in the apple industry and a rise in output in the machine industry. And in Canada, the opposite will be occurring. The apple industry will be expanding. So we will see a rise in apple production. Let's say they stop at this point here. And we will see a decline in machine production as they plan on importing some of the machinery they need from the United States. And this is the book makes the distinction between the short run and the long run, and I'll just remind you what's going on. When I say that the factors shift from one industry to the other, I'm essentially already in the long run. I'm not going to dwell on the short run. The book deals with that just fine. But in the long run, all factors adjust to the new prices. So that, for example, we start trading with the Canadians, all the cheap apples come in, and there's a new market for machines, and all the capital and labor adjust to that new situation. In the short run, factors are tied to their existing sector, meaning that they don't have time to respond to the new situation. And it just gives you a slightly different perspective Essentially, if you happen to be lucky enough to be working in the machine industry in the US, you benefit regardless of whether you're a capitalist or a worker. And if you happen to be working in the Apple sector in Canada, you benefit regardless of whether you are a capitalist or worker. That's in the short run. But this is the long run, and I know it's the long run because I'm showing people adjusting to the new reality, that there are new markets for machines. We see the US moving from A to B, and then we see maybe the Canadians moving from A prime to B prime. All right, so we're in the long run right now. And this has some interesting implications, and it's really just a story that we can tell. How does the machine industry expand in the US? Well, it expands by picking up the capital and labor that is departing the Apple industry. But then we have this sort of issue that is going on, which is that the mix of factors departing the Apple industry is essentially, you can think of it as too rich in labor, because the Apple industry was the labor intensive industry. So we have lots of labor relative to capital. But the machine industry is expanding, and the machine industry likes to pick up a mix of factors that has a lot of capital and less labor. So by definition, machines are capital intensive and apples are labor intensive. When the Apple industry contracts, as we can see it doing here, it goes from, say, A1 amount of apples to A2. The contracting Apple industry is freeing up this sort of very rich mix of labor relative to capital, and the machine industry would like to pick up capital and labor in proportions that are relatively richer in capital. So in factor markets, and at least in these simple models, we assume that factors are fully employed, which means we have competitive factor markets. We will see falling wages because we have this excess supply of labor, and rising returns to capital. Let's say R for the interest rate maybe. So wages, the price of labor, so let's call R the interest rate or the return to capital. So very quickly you can see that the expansion of the machine industry doesn't have an even effect across all factors in the economy. In fact, it clearly benefits the factor that is used intensively in the machine industry. And the opposite is happening in Canada. We can just quickly sketch that out. The expanding Apple industry wants to pick up capital and labor industry, capital and labor in a ratio that is very labor rich. This will tend to put upward pressure on wages, and the relative surplus of capital being freed from the machine industry will put downward pressure on the returns to capital. So we get several different things, which is that trade is beneficial to factors used intensively in export industries. So in the US, for example, we export a lot of goods that are very knowledge intensive, so educated workers have done well from trade. Trade is beneficial to factors used intensively in export industries. And this is another funny little thing that you can see, we also get something called factor price equalization, which the book does a nice job explaining, but we'll just quickly see that at work here, because what you can see is that the US had an advantage in machines because they were abundant in capital, meaning capital was relatively cheap, but expanding export markets put upward pressure on the rate of return to capital and downward pressure on wages. And the opposite was true in Canada. They had the advantage in the apple industry because wages were relatively low, and they had a disadvantage in machines because machines were relatively high. But you can see what's going on here. Let's have a nice new color like a red. This will show you. Well, we've got this thing called factor price equalization going on, because you can see that wages are falling in the high wage economy, which is the US, and rising in the low wage economy, and the price of capital is rising in the US, which was the cheap capital economy prior to the opening of trade, and falling in Canada, which was the expensive capital economy prior to the opening of trade. So we get this thing that's pretty important called factor price equalization. In rich countries where labor is relatively expensive, you get this terribly controversial effect of free trade, which is that trade puts downward pressure on wages, and we see that happening. And of course, trade unions in countries like the US or the European Union are some of the biggest opponents of free trade because of this negative effect on wages.